Hi there, my name's Andrew Barnett, Senior Trader here at Trading Mastery, and welcome to this special training video today where I'm going to share with you 3 simple tips to reduce your risk when you are trading, but not necessarily reduce your return. So let's talk about tip number 1. Now, whenever we place a position in the financial markets, whether it be in the stock market, whether it be in the currency market, futures, oil, whatever it might be, it is critically important that you know what your downside risk is. Here at Trading Mastery, and when I'm trading my own account as a professional investor, I'm always very aware of what my worst case scenario is. And I tend to find a lot of traders that I've mentored over the years, and particularly here at Trading Mastery, those traders first starting out on the journey, they're very focused on the upside, very focused on what they could potentially make. And the focus is not really on the most important thing, and that is what is the downside. So with respect to, for example, if you're trading in the currency markets, you can manage your risk based on the capital that you have in your account to around about a 2 to 3% risk profile. And if you don't know how to manage risk successfully, then you need to be able to learn to do that, because unless you can keep it consistent, what's going to happen is you're going to get the odd drawdown from time to time that's going to destroy your trading account. If you're in the stock market and you have a portfolio of stocks, you need to make sure, in my view, that portfolio is not risking your capital of any more than, say, 15 to 20% maximum with respect to drawdown. So my first tip is today to make sure that any position you place in the market, whatever market you're investing in, is that you know in the worst case scenario, when the market moves against you, where are you going to get out and what is it going to cost you? That's critically important. Okay, tip number 2, don't try and hit home runs on every single trade that you take. And what I mean by that is a lot of traders invest far too much volume on individual trades and expose themselves too much in positions. And when the market does go against them, it's an emotional experience. They often exit those positions too late and they have major drawdowns. Stop loss limits are there for a reason. They're there to limit your loss, but they're not there to limit your profit. But it is critically important that every trade you take, you're just taking another bite out of the apple. You're just eating the apple one bite at a time. You're not trying to swing and try and make $1 million on one trade. What you want to be doing is making sure that when you do place a position, you know what your downside risk is, it's volume sized correctly, so as when the upside does happen, you're going to be able to take advantage of that. So don't front load positions. Don't put all your money on one position. Don't fall in love with one trade setup. If someone says to you, this is guaranteed to go up or guaranteed to go down, that's a complete nonsense. Nobody knows specifically where a market's going to go on an individual trade. So don't ever fall in love with the direction or one trade that might pick you up a nice healthy return. Always focus on that risk management side. It's not limiting the upside. Having a stop loss is limiting the downside. Now, my third tip that I teach at Trading Mastery, and I want to share it with you today, is making sure that you understand what your risk-reward ratio is. Every professional trader will understand what their risk-reward ratio is. And what I mean by that is for every dollar that they risk, on average, what do they make? And I'm going to give you an example here. If you're investing, and I'm just going to pick a figure, and your average loss was $500 and your average win was $1,000, your risk reward ratio would be 2 to 1. And that's incredibly important to keep abreast of what that risk reward ratio is. The easiest way to work out what your risk reward ratio is go into your trading statement, add up all your profit and loss, work out what is your average win versus what is your average loss, and work out that exact figure, because it's going to tell you whether or not you're going to make it in this business. Your risk reward ratio needs to be close to 2 or better, 2 to 1. Now, if you are averaging a $500 win and a $500 loss, well, your risk reward ratio is 1 and your probability is low that you will make it in financial markets long term. In fact, unfortunately, the average retail trader, when they look at their risk reward ratio and they work it out, it's actually under 1. they actually often lose more than the average winning trade. The defining difference between a professional investor and a novice amateur investor is their risk-reward ratio. It's not about how many times you trade that will see you be successful. It's not about the market that you trade that will see you be successful. What successful trading is about is when you win, what do you make? And when you lose, how little do you risk? So be very well aware of what your risk-reward ratio is. For more trading tips, you can jump across to the tradingmastery.com.au website. I'll see you next time.